I am thrilled to bring in Caleb Sevian, Focus Point Capital founder, to have a good conversation, just around 20 minutes or so again today. As always, no charts or graphs. We're right at the beginning of February in 2026. Caleb, after our last discussion to finish 2025, you've got a lot of fans out there, so I'll just say no pressure. Just deliver as you always have, and everybody will be happy, okay, including me. So welcome back. Glad to have you here.
Thanks, Lou. I appreciate it. I appreciate you opening up the mic and spending time with me.
Yeah, it's great. It's always great. So let's jump right into it because the stock market and when I say markets, generally speaking, I'm saying stock market. I'll point out bonds when we get to that question in a few minutes. The stock market continues to rise. The International Monetary Fund has updated their numbers to look even better, which has caused the stock market to increase again. Why does the stock market continue to go up when there have been a lot of reports of negativity out there? What is your perception of the markets and why they continue to increase in value?
So I would say I would split that question into two parts, because while the IMF raised their forecast for global growth, and they did that on January 19th. They raised it from 3.1% to 3.3%. And that follows a very similar pattern to Bloomberg economists for the U.S. GDP. There's Bloomberg surveys 75 economists every single month, and the economists' projections for 2026 went up from 2% to 2.4% off the back of consumer spending going from 1.9 to 2.2. So those are all measures of the economy. And I think one of the things you said was the stock market continues to go higher. So I think the stock market continues to go higher and the economy continues to get more momentum. Those are not necessarily the same things. We can talk about with some of the differences between the economy and the stock market. I mean, it's not that the economy is not the stock market, but it's also not the stock market. Right.
So we did cover that in a previous video with Dan.
Yeah, we did. We did talk about that. So
yeah, you and I talked about that. Sorry.
So let's talk a little bit about what's caused growth forecasts for GDP to go higher for both the IMF and for Bloomberg economists. One is this continual sort of repricing of tariff-related fallout. So that's been an issue that I think, starting actually as soon as Trump began discussing tariffs, people started to strip growth out of the economy, and it hasn't transpired that growth has gone lower. And so what we're seeing is an increased layering in of growth, as it shows that growth is not falling off a cliff. And that happened starting, in May, and it's continued almost every month since. And you can see it with the Bloomberg survey also asks a question of, what do you think the probability is we'll be in a recession in the next 12 months? And that was at state at 30% in January, but it was as high as 40% in April. And it's just kind of been on this slow trajectory down, and it's the same answer to the question, which is, really tariffs have not played out as bad as people thought they were going to play out. The other thing is this continued AI adoption, and now we've moved to this next phase for task automation, innovation, scaling that provide upsides. The fact that we're actually starting to get AI in the ground and running, so you get sort of the supply chain resilience that people were worried about didn't transpire. The AI adoption's better, and then we've also had when you look across the world at central banks. We've had this coordinated easing over the last year of central banks, and now most central banks are troughing, and in fact, places like Australia look like they might be raising rates next. And so, and those are real risks and real possibilities as inflation ends up too sticky, and the job growth ends up being stronger than people expected. So, I think that when you end up having kind of low interest rates mixed with high growth potential, you got to take growth targets up.
Sure, you get that is rocket fuel for stocks and the economy. And then again, we've had several discussions, you and I, also others, about the stock market not being the economy, but as you mentioned, not entirely separate, of course. And we always fall back to just in the political realm. Policy is what we really follow as investors, not politics. So as the policy impacts come about, then we have to make the decision of, all right, where do we position portfolios from that point on? Let's go to commodities, because we've all watched gold have its rocket upwards. Silver, attached itself to gold for some time now, and then had just a crumble last week. And I guess I should have gone with silver streaked, and and gold shined. If I really wanted to, just use every corny analogy possible. But what does this mean to the stock market, even to bond market? Because so often the commodity trade, the purchase of silver and gold, is associated with inflation. So if job creation is strong, if interest rates are low, is the gold and the silver, or are the gold and silver trades an indication of inflation to come, or inflation that we've already seen?
Yeah, well, I mean, I think, and again, to kind of differentiate, because you mentioned a couple things, right? You mentioned commodities, and you mentioned gold and silver, right, precious metal, industrial metals. And if you look at actually commodities in general, right? Right now you can kind of break commodities into two big pools. I don't know if you took chemistry in college or high school, but you have your inorganic chemistry and your organic chemistry. So your inorganic chemistry is things that are on the periodic table that don't have a carbon atom attached to them. And those are things like gold, silver, aluminum, zinc. These are things on the periodic table. Those are all doing really well. And if you look at the inorganics or the organics, right? Like oil and sugar and things with a carbon attached to them, they're not doing as well. So you kind of have the split commodity market where you have things, especially things that have scarcity associated with them. And I would say that you and I talked about this just a little bit before we started this webcast too, which is historically gold had lived in a place, gold and silver. Silver is more of has some industrial uses because it's a superconductor, better conductor than copper even. Historically, gold had lived in this place where it was a marker for inflation stability and therefore interest rate stability. So if you're worried about inflation either going too high or too low, people flock to gold to protect themselves. So it acted as a good indicator for inflation stability. Today, that need still exists as a marker, but it's been overwhelmed by something different. It's been overwhelmed by geopolitical uncertainty. It's become gold and silver have become the relief valve for geopolitical uncertainty. And so when Russia invaded Ukraine, the Russian assets, U.S. dollar assets were seized. That was a wake-up call to anybody who had U.S. reserves sitting in a bank somewhere, that those reserves belong to the United States, not them. And so central banks around the world began buying dollars, buying gold. And so that created a bid for gold. And then with Trump coming to office, we've had this de-dollarization trade. And so de-dollarization means that people just have become more uncomfortable with U.S. policy, and that's created a desire to repatriate their investments back into their country. And if Trump has his way, which is we reduce the deficit, people will have less dollars to spend anyway, right? So foreign investors, the way it works is, you buy your toy remote control car, and you give your dollars to China for the toy remote control car, and now they have your dollars. They don't have the car anymore. You have the car, and they have your dollars. So what do they do with their dollars? Well, they're going to invest their dollars. They're going to invest them in treasuries, and they're going to invest them in stocks. So if you look at the total foreign-owned securities of the United States, the United States foreigners own about $31 trillion worth of U.S. securities, equities, and debt in the United States. So they own about 20% of the entire United States equity market. And so if all of a sudden now we buy less toy cars from China, right, because we don't want to do that anymore, regardless of whether you think that's a good idea or a bad idea, now they have less dollars to spend in U.S. stuff, so they're going to buy less U.S. stuff. That's less demand for dollar. That's going to create a weaker dollar, right? So that's going to create de-dollarization there. It's also going to, and also if at the same time, maybe some of our trading partners, some of our allies are less happy about the way that U.S. policy is geared towards them, and for instance, the Danish pension fund said they're selling all their U.S. treasuries, $100 billion worth, right? Mm-hmm. So all of a sudden, they don't want to own those. So now that's going to create, a weaker dollar. And so you're going to end up having this weaker dollar, less demand for dollar instability, and that instead of inflation instability, it's dollar instability and geopolitical risk that's driving a bid for gold. And then to compound that, you have these supply concerns, right? So everybody's wondering, like, hey, am I even going to be able, as China's wondering, like, am I even going to be able to get silver to make, silver's like huge industrial component of solar. And China's like, hey, am I even going to be able to get silver for my solar components, because the United States is, going to cut off strategic supplies somewhere and make it hard for me to get silver. So there's this stockpiling by commercial users of industrial metals. So industrial metals have stockpiling. Gold has the safety bid. Silver gets both of those, and then on top of you got what I would call the investment tourists. So the people who are the speculators who are chasing the trades, and as soon as gold and silver start going up by every single day especially by double digits, you get speculators. Everything becomes memeified. It right. becomes a meme coin, and then what you have from there is I wrote about it this last weekend. Is I looked at the last 50 years of history of gold and the volatility in gold over the last 50 years, and what you find is when it has these parabolic moves up, which I defined as, with a mathematical method that I won't get into, but when it has these parabolic moves up, what it means is for the next 3 to 6 months, you have volatility that can be 3 to 5 times normal. So you have these parabolic moves up, and then guess what? Put your seatbelt on, because it's going to get really bumpy. And so we saw that last week, right? So because what ends up happening is you get, it's not just me saying it, it's the Chicago Mercantile Exchange raises their margin requirements on gold, raises the margin requirements on silver. They did it Friday at 2:00 in the afternoon. And that's when you saw gold prices and silver prices fall off a cliff, because everybody realized Monday morning when they get to work, they're going to get a margin call. So they had to sell their gold and silver. And so, so exacerbating this is that any of the speculators now have to deal with margin calls. If you're a speculator, you probably don't just own gold or silver. You might own Bitcoin. And there's real proof of that. Like Bitcoin over the weekend hit 76,000. That's lower than it did on Liberation Day. So after Bitcoin went as high as 125,000, it went down to 76,000. So I mean it's gotten hammered. So the question is then, what else does people who are speculators own? They own Bitcoin, but they also own tech. They might also own other stocks, and so they're just going to be selling wherever they can have liquidity. So you end up with cross asset class volatility as a result of these big spikes in gold. So it gets to be a very complex. I love complex systems. You dump something in one end and it just works its way around the whole system.
Of course. Well, and I just want to, I do want to define margin for those who are listening, watching, and don't deal in those terms every day. Margin would be, I have, let's say $100 worth of gold, and my investment account or custodian will allow me to borrow against that $100 worth of gold up to, let's say, $50 more of security purchasing. So I could actually own $150 worth of gold, but only have $100 in hand. Well, if the value of gold, and that would be a 50% margin, if the value of gold drops from 100 to 75, now all of a sudden I have to make up that difference of my $50 that I borrowed. I have to put that in cash to go back to the margin percentage that they've made available to me. Caleb, did I describe that correctly?
Yeah, and in fact, good. It's more extreme than that in the case of gold, because the margin requirement for gold on Friday before they raised it was 6%, and they raised it to 8%. So that means if you wanted to buy $100 of gold, you only needed $6 in your account.
Custodial account. Yeah.
Your custodial account to buy $100 worth of gold futures, but now all of a sudden you needed $8. So you went up by 33%.
33% increase, right? Which is significant because, right, and as you mentioned, then it leads to the sale of some other asset in order to meet that 33% increase of the margin. So it has a cascading effect on markets, and it can unwind very, very quickly, which is again why we look. I like to say that we look at things. We love to grow money, and that's we all know that's our purpose. But I like to look at things with a New Jersey slant eye, if you will. Like, let's make sure that we're growing it, but we're doing so conscientiously. We'll put it. All right. So we do have to jump from there to keep moving on to bonds. You and I have had discussions about duration on bonds, and you've been, I'll say, adamant for a good stretch here to stay under approximately a 7-year duration on what you hold. Is that still the case? Please tell us why that would be the case.
Yeah, I'm fairly bearish on the long end of the curve. So that means long end of the curve means longer dated treasuries. So anything over 10 years, I'm pretty bearish on the longer end of the curve, because I think when you look at the long-term fundamentals of the U.S. economy and borrowing for the U.S. economy, the U.S. economy, I mean, with over $30 trillion worth of debt and having to refinance $10 trillion a year, that just gets harder every year when you continue to run a deficit at close to 6% of GDP. So it's just going to be, what it'll mean is it means more and more borrowing. And at some point, the credit worthiness of the country gets called into question. And we've seen that over the last few years with S&P downgrades, Fitch downgrades, Moody's downgrades to U.S. debt. And it's because the long-term dynamics of the United States don't look good. And so anytime you say the long-term dynamics don't look as good, that means the term premium, which is the premium that you have to pay to borrow for a longer time, should increase. And when the term premium increases, that means the longer end of the curve goes higher. So with the new Fed president, new Fed chair coming in, and the expectation is that interest rates will go lower, but not a lot lower, probably somewhere between 50 and 75 basis points lower. We know what the front end of the curve is going to look like. We know the front end of the curve, which is at 3.5 right now, it might go to 3, it might go to 275. So we know that that's what it's going to look like, but we don't know anything about what the long end of the curve is going to go like. That's based on issuance, that's based on inflation expectations, that's based on growth expectations, and there's nothing that makes me think that that's not going to come under pressure. Now, the thing that can change it is something that I can't predict, which is yield curve control. So what could end up happening is it could stop issuing at the long end of the curve. So now if the only issue at the front end of the curve, and there's no long end of the curve treasuries, there's going to be a supply shortage of long end of the curve, and the demand for them will go up and long end will go down. I don't know what the policy shift is going to be, but they could do something like that. They could not issue at the long end of the curve. The Fed could do what they did in after the financial crisis, which was QE with a twist. So the twist is that they bought long-ended securities to push the long end down. And so the Fed could buy long end securities. The Treasury could not issue long end securities. So the government could manipulate the yield curve, but in the absence of the manipulation of the yield curve by either the Fed or the Treasury, there's only one direction for long end Treasuries to go, and that's higher. And so that tells you, like, you want your duration. You're safest on the front end of the curve because we know that's going lower. On the middle of the curve, the belly, what we call the belly of the curve, that belly of the curve should be pretty stable and it could go a little lower, but the long end of the curve will likely over time just continue to drift higher.
Yeah, I find it fascinating, and the impact, it can't be overstated, which is why you have to spend a few moments on it, the technicality of it all, because it really is a market that, well, go back to the risk-free trade. For everyone watching, the risk-free trade is treasuries, meaning if I wanted to take no risk with my money, I would go buy U.S. treasuries, my money would sit there. Well, risk then gets measured against that. If I'm going out into the stock market, how much risk am I willing to take versus the risk-free trade of buying U.S. treasuries? Well, if they're at 3.5%, just as an example, I would be expecting that because I'm taking risk with my money in the stock market, I should be getting significantly more. I should be getting paid for that risk with a higher return. Well, it impacts the long end, as Caleb is talking about, 10 years plus on the bond curve. If it's elevated, I'll just use a random number, okay, as an example. If the long end is suddenly 6 or 7% interest rate or return on your bond, well, now the stock market has a ton of pressure on it to deliver double-digit returns. And that is not something that you should consistently expect. And you could get a lower risk investment that at 7%. So it's fascinating. And so it again, the cascading effect of not just we talked about silver, gold, commodities, but bonds. It has a deep impact on the stock market overall. Now, I do have to move on to proposed or nominated Fed chair, the speculated nominated Fed chairman, I think is the right way to put it today. Why did the markets for a day or two here react negatively? Keeping politics out, okay? It doesn't matter if you're Democrat, Republican, Independent, whatever it may be. Why would there be such a immediate negative reaction to the proposed Fed chair, the nominated Fed chair? I'm sorry.
Right, because I would say because it was down to three, basically. It was down to Warsh, it was down to Kevin Warsh, it was down to Rick Rieder from BlackRock, and it was down to Christopher Waller, who is currently existing Fed president. And so it's down to those three. Out of the three, Warsh was viewed as two things. One, the most hawkish out of the three, and two, the most partisan out of the three. So the market doesn't like that because the market is then expecting there to be a floor on how much lower interest rates can go. And then this part of the fact that he's the most partisan calls into question the credibility of the Fed. If you're going to put someone extremely partisan at the head of the Fed, it becomes a more partisan organization. Independence is key to the Fed. So I would say Warsh, although people weren't, it wasn't that people weren't expecting that to happen because he was down to three, but he was probably a little bit of the dark horse. And he has a history when you look at him, when you look at from when time he was on the Fed previously, in 2007 through the financial crisis. He was the last Fed governor to one of the last Fed governors to throw in the towel and say that we should cut rates because he didn't want to cut rates. He was one of the first Fed governors to say we should raise rates. And the entire time he was fighting the Fed using their balance sheet and expanding their balance sheet. So that was his history through the financial crisis. And then when he moved over. He resigned in 2011, largely because he disagreed with the use of the balance sheet, and then he moved over. He most recently moved over to the Hoover Institute, where he was extremely critical of the Fed for not raising rates sooner and raising rates faster. So every single time he's had an opportunity, he's been on the side of raising rates. And now all of a sudden he's being nominated by Trump, and people are expecting him to just shapeshift and be in favor of cutting rates.
Mode. Yeah, right.
Yeah, and that just seems less likely. And so that's what precipitated the big sell-off in the dollar, or the strengthening of the dollar, because the dollar had been selling off all last week on this debasement, de-dollarization theme, and all month. And then when Warsh was selected, because he's perceived to have a floor under how much he'll cut rates, then people are like, okay, well, rates aren't going to go to 2 under Warsh, because this guy does not like to cut rates. And so, but having said that, we really don't know, because I mean, clearly he's signed some, he's done some kind of, Rambo move, like cutting his hand and doing the blood handshake with Trump to get in there probably. So that he's going to do what Trump wants him to do, and that is, but we don't know for how long, and we don't know what's going to happen, because it is an institution in and of itself, the Fed, and when he's there, he may choose to act more independently. And if he goes back to his knitting and his colors, the way he'll end up is be more hawkish.
Okay, thank you for all of that. Even the Rambo part of it, that's funny. But with that said, it's also not done. He's not the Fed chair at this point, and there is some speculation that he may not even become the Fed chair. So we'll let it play out and see where this shakes out. But interesting. It's an interesting twist to the possibilities here of lower, higher short-term interest rates. And one last thing, I'm just going to ask you for a minute on this. Your outlook for the remainder of 2026 in the stock market specifically. I know that is no return. You don't have to give us returns, just the overall outlook, positive, negative. Give us an a why on that, please.
Sure. I mean, I look at it as more probabilistically, right? So I look at the stock market in the outlook as, what are the chances that we're going to kind of, chug along and do what we've been doing versus, something goes wrong or something goes really right. And I'd say, if I put in those 3 categories, I'd say there's, a 50% probability that things will go kind of as they've been going. And there's probably roughly split either way, that we could end up into something unexpectedly on the downside and something unexpectedly on the upside. So let me just get into what would cause any of that to shift, and that is, I think where we are today is, we mentioned this, that GDP is growing at roughly double potential. Right. So last quarter grew at 4.4%. This quarter, according to the Atlanta Fed GDP, now we're growing at 4.3%. So the potential is 1.8 to 2%. So it's over double what the economy is growing at versus potential. Earnings right now for the S&P for the fourth quarter, as of Friday, with 33% of the S&P reporting, they're at of the S&P 500 reporting, they're at 11.9%. That's roughly twice the average annual rate of growth of the S&P 500. So we've got a strong economy, strong earnings. You still got this AI supercycle story going on. Now it's getting a little long in the teeth, right? People are wanting to see an ROI. It's shifted from free cash flow spending to debt-funded spending. And so there's more accountability associated with it. And we've stopped seeing the sort of ramp in growth. It's still growing in terms of what people are spending on CapEx, but the rate of change of growth has slowed. And that's the first sign of things turning over. So it's not that growth isn't continuing; it's the rate of change of growth that has slowed. And then you've got the tax refunds, which are going to inject $100 billion potentially into Q1. You've got the OBBBA fiscal incentives for companies. They're probably injecting another 150 billion of corporate incentives. So these are all really, really good things. But then you have this thing that's balancing it out. And then you've got this overarching issue, which is, I would say, you've got this good growth, but you've got this kind of stagnant to weak labor market. So the question then becomes, how will that get resolved? If you have a lot good growth, but you have weak labor, is labor going to catch up to the growth, or is growth going to catch down to the labor? And so, or are they going to stay roughly in this kind of awkward balance where you have good growth and weak labor growth? So that good growth, weak labor growth is sort of the 50-50. Right? That's a 50% case where I'm like, that's probably where we'll end up. But we could end up with good growth and a good labor market, in which case we're going to get inflation, right? And that initially will be good until they start raising rates, and then that's bad, right?
Yeah.
And then the other side of that is that labor catches down to inflation, or to labor catches down to the growth, and growth starts to, the things that people talk about, like this K-shaped economy, that the people at the bottom are really suffering. And they just run out. And the reason that they've been continuing to spend is because they've been drawing down their savings. So they say, okay, well, we've drawn down their savings as much as we can draw them down. Now all of a sudden they spend less, there's less jobs, and we end up on this spiral down. So that's why there's these sides on either side where you could have an inflationary boost and things could get even better, or until they don't, right? Until they have to raise rates.
It's
or you
just
could have
exhausted, right?
Yeah, and then you could have this downside where, where basically the low-income consumer, because we've been operating this sort of very lopsided economy, where people who have houses and people who have stocks in their portfolios are doing really well. But if you don't have a house and you don't have a 401k with a lot of stocks in it, you're suffering, right? And that's half the economy. And so, and wage growth has been stagnant. So the way that they're surviving, the way that they're continuing to spend, is they're drawing down their savings. And so at what point do they hit uncle? And so, and then you layer all this on top of this whole thing, this, what I would call this threshold of political instability. And so, and the question is, what is the threshold that we reach on instability from policy and geopolitics, where it just becomes too much weight for the market to bear? I mean, let me give you I don't want to take up too much time because I know we're sort of at the end.
Yeah, just another minute. Yep.
But I'm going to run through just a list of some of the stuff that happened in January. And it is, in my 30-year career as a professional money manager, I've never seen so many things happen in 1 month. And, we had Venezuela, we had Greenland, Venezuela, United States, basically going in with military force in another country and pulling out their leader. We had Greenland, where the United States, said they weren't going to rule out military use against an ally, and then threatened to tariff allies. We had, Japanese bond yields blowing out. We had Trump trying to indict Powell, the chair of the Federal Reserve. We had Canada threaten to raise Canada tariffs 100%. We had threats to raise Korea's tariffs 25%. We had huge changes proposed to health insurance. We have aircraft carriers positioned off the coast in the Middle East for attacks on Ireland. We have Trump suing J.P. Morgan, Trump suing the IRS, the Fed being nominated to Warsh. We've had what I call some of the state capitalism issues, where Trump said that defense contractors had to cap the pay of their executives and couldn't do stock buybacks. We've had freezing out of private equity from residential real estate. We've had credit card borrowings proposed to cap at 10%. These are, and we're just scratching the surface in things I can say in 1 minute. And so this is a lot of instability thrown at the market at once. And at some point, you're going to have a threshold where uncertainty creates a situation where people don't want to, are afraid to invest.
Got it. Well, you know what? We are not afraid to invest. Look, I ask, you answer, and I really appreciate it. And I know clients appreciate it. Everyone that watches this appreciates it. So we are going to leave it there. What this allows us for is another conversation come the summertime. Is that correct? Because we have to revisit this long list of January of we'll call them concerns, but also opportunities. So we'll just have to revisit it, Caleb. Correct?
Absolutely. I look forward to speaking again
Excellent.
soon.
It is always fun. Thanks so much. The detail is real and appreciated, Caleb. So again, we'll do it in the summer. You have a great rest of the day. Thanks everybody for watching, and always welcome your feedback on these conversations.